Okay, so thank you for joining us today. This is on local government, and we're here for the economic update and 10 threats to local revenue. So we are going to be moving into breakout sessions, but the main portion will be recorded, and we're doing that now. My name's Tamara Ogle. I am with Purdue Extension Community Development, and we also have several educators you might notice when we move into the breakouts helping today. So we're very thankful that they've taken the time to learn about this and to study up so that they can help lead those breakout sessions and help facilitate these local discussions. We're also really excited to hear from you. So this is our first time doing this through on local government, but Larry and I are sorely missing getting out in the state, doing our local government finance workshops and learning from you, because we see things from a 30,000 foot view. And when we go into and do these local programs, we learn a lot, which really helps us to do our job. So we're excited to be able to hear from you today. Larry, I'm going to introduce you so I can quiet my kids, but take it away.
All right, thanks, Tamara. Well, I'm Larry DeBoer. I'm professor of agricultural economics at Purdue and an extension specialist on state and local public policy. And kind of at the beginning of this event here, I told Tamara that I loved having little kids, and I love not having little kids as well. And so I don't have the noise problem that so many others do have. Let me reiterate what Tamara said about learning from folks who are out there. As she said, we study Indiana local government, but there's nothing like actually doing Indiana local government to learn what's going on. And so we hope to hear from folks out there as to what's going on, especially with revenues, property tax, local income tax, motor fuel, motor vehicle excise, or excuse me, motor vehicle highway fund and local road and street fund revenue of schools. What are the schools thinking about their future state aid? Well, that's what we'd really like to know about as we're going forward here. So we hope to learn as well. Well, let's talk about the COVID-19 recession and Indiana government revenues. I saw a tweet last night asking whether we're still going to call the Great Recession of 2007-2009 the Great Recession, considering what's going on right now, and that this recession is certainly going to rival that one in severity. I personally think we'll probably just call it something like the Corona recession or the COVID recession or something like that, and leave Great Recession for the one 10 years ago. But here we go. What's going on out there in our economy? Let's start with the unemployment rate. The unemployment rate is one of the numbers that we do have a pretty good handle on now. One of the problems with this recession, with knowing what's going on in this recession, is that it happened so suddenly that all of a sudden the data was lagging way behind. Ordinarily, you ask me the question, what's the unemployment rate? And I can tell you, based on what the survey said the last time it was taken, and sometimes that's 4 or 5 weeks ago. But this time, back in April, they said, what's the unemployment rate? And the last read we had on it was 3.5, and boy, we knew it was higher than that. And so now we've got a little bit better handle on the thing. And what you see here are two different unemployment rates, and U3 is the headline rate, and that's the one that gets talked about in the papers, and that's the one we call the unemployment rate, and it's 14.7%. Problem is, and the Bureau of Labor Statistics, the government organization that tabulates the unemployment rates, they acknowledged this, that the methods they use in their survey might not have fully captured this very sudden, very unusual event. They weren't built for a stay-at-home order, for example. And so usually the definition of unemployment, to be counted as unemployed, you are without a job, but looking for work, and you would have had to have made efforts to find work during the survey week, during the week that the survey was taken, or you're on layoff awaiting recall, and those are the people who are counted as unemployed. So how do you count the people who were dismissed from their jobs and told to stay home or on furlough? Are they unemployed? Are they employed? Are they not in the labor force? It made the definitions difficult. So maybe the thing to do, though, the BLS, the Bureau of Labor Statistics, come to the rescue from the fact that they publish actually every month 6 different unemployment rates under 6 different definitions of unemployment. And U6, the most expansive definition, is probably the best one we've got right now for measuring what's going on with the unemployment rate. U6 includes all the people who are ordinarily counted as unemployed, plus people called discouraged workers, and those are folks who are not working, say they want a job, but haven't made an effort recently to look for a job because they're discouraged. They don't think they can find one. And certainly that will also include the folks who have been laid off and told to stay home and figure there's no need or no reason to look for a job because there aren't any, and besides we're supposed to stay home. Plus, they also include involuntary part-time, which means people who would like to be working full-time but are only working or can only find a part-time job. And certainly that would include all those folks who've been furloughed or been put on half-time by their employers as business activity has declined. So U6 probably pretty good in terms of capturing what's going on out there. And the U6 unemployment rate was 22.8% in April. And now to put that in context, that is the highest unemployment rate in the history of the monthly unemployment rate survey, which started in 1947. We have measures of the unemployment rate, annual measures of the unemployment rate for the Great Depression, and there's several different ones because different historians have gone back and done it, and the one that I tend to use has the highest rate in the Great Depression at 22.9. You know, whether it's 22.8 or 25 or 20, I don't think it matters. All we need to know is this is an unemployment rate that is equivalent to the Great Depression. So this is the worst unemployment rate any of us have ever seen. What about gross domestic product? Well, that also suffers from this lagging data problem. Gross domestic product, the output of goods and services in our economy, is measured quarterly. And so the most recent measure we've got is the first quarter, January, February, and March. Now, we know that the recession got started in March, and so January and February were pretty much normal. And our guess for what happened in January, February is that the economy just continued to roll along the way it had been increasing for the previous several years. In 2019, for example, GDP grew 2.1%. And so if we say, hey, in January it grew 2%, in February it grew 2%, but for the entire quarter it went down almost 5%, what must have happened in March? Well, what must have happened in March is minus 19%. That's how the arithmetic works. And that sounds something like what we probably have experienced, a 19% decline. Now, one thing to know about this, and this is going to be talked about quite a bit for the rest of this year at any rate, is GDP numbers are usually reported as an annual rate. And that basically means we took what happened, or take what happens in the quarter and multiply it by 4 to say, here's what GDP would be if what happened this quarter were to continue for the entire year. And so that means that the minus 4.8% that we see in the first quarter probably represents minus 1.2% in terms of what happened in the first quarter compared to the fourth quarter. But if that were to continue for an entire year, it would be minus 4.8%. Now, we do that ordinarily because it's really convenient to be able to compare quarterly numbers to annual numbers. You know, if nothing unusual had happened in the first quarter, and the growth rate for the quarter had been 0.5 of 1%, we would have multiplied by 4, said, hey, that's 2% increase, and we know that the economy is doing the same thing in the first quarter that it did in 2019. Well, now, however, if we multiply by 4, we sometimes will get very large, even ridiculously large numbers. For example, and this is new information since yesterday when I did this talk for an earlier group, we have the Congressional Budget Office's projection of the economy for 2020 and 2021. Now, usually the CBO will do projections in January and August and leave it at that. This time they decided we better do an interim projection, and they did. And they've got the second quarter declining by 38%. Now, this is an annual rate. It is not that the economy is going to be cut down to 60% of its former size. what that represents is about a 9.5% reduction, which is an enormous reduction from one quarter to the next. But times 4 is minus 38. So just to be aware of that. Still, what we're saying is that March, April, May, June, the biggest single quarter or 4-month drop in the economy that we have ever seen since quarterly GDP began back in 1947. It is also undoubtedly a bigger single quarter drop than anything that happened during the Great Depression, which kind of gathered steam over about 4 years from 1929 to 1933. So the economy dropped off the table, let's face it, and we know that happened. It's important to know, I think, in order to understand what kind of recession we've got here, to take a look at a couple of the components of GDP. And here's investment spending. Now, investment spending is spending mostly by businesses on buildings and equipment and inventories and software, and then we toss in home construction as well, and that's investment spending. And investment spending went down 5.8% annual rate in the first quarter, and that's a little bit less than the decline in the fourth quarter. So what happened to investment spending in the first quarter was not so different than what had been happening to it the year before. Investment spending had actually been declining. Now, compare what happened in the first quarter to what happened during the Great Recession, 2007 to 2009, and you may be able to see that it's shaded on this diagram, and that's the downward phase of the Great Recession when the economy was declining. You can see that investment spending had been declining for about 1.5 years before the recession actually started at the end of 2007, and the annual rate decline got up all the way to almost 50% at the worst phase into late 2008, early 2009 of the Great Recession. Well, the Great Recession was led by declines in investment spending, but that's not true this time. It's not a collapse in investment that is causing this recession. It is instead a collapse of consumption spending. Now, consumption spending is spending by households on consumer goods and services. And so you've got durable goods like cars and appliances. You've got non-durable goods like food and pharmaceuticals. And you've got services like visits from the plumber or visits to the doctor. And so what we see is a decline in the first quarter of minus 7.9%. And that means that in March, the decline was more than 20%. So it's a very big drop in consumer spending. Well, why not? Consumers were told to stay home. But as we'll see, that isn't the only reason for this drop. Right? It isn't just that the stores were closed and people were told to stay home. We've got some other reasons for this as well. We can kind of confirm this by a report that came out last Friday. So new information keeps rolling in here. Last Friday, we saw the report from the Bureau of Census, which does a monthly measure of retail sales. And here I've got it ranked by different categories of retail sales, you see. And right at the top there is non-store retailers. That's online shopping. And it grew 22%, as you might expect. And that's the biggest single month growth that we've ever seen. This is, by the way, these percentage changes a little different from what got reported on Friday. This is not the comparison to March, and March was already down. This is a comparison to what happened last April. So if we think of last April as kind of normal, how abnormal was April of 2020, right? How far down are we compared to what was a normal month 1 year ago? We're 22% up for non-store retailers. Food and beverage stores, that's grocery stores and liquor stores, up 12%. And a lot of stocking up going on in April. Building and garden materials were 0, no change. Everything else was down, and some were down a lot. And you can see electronics and appliance stores down 65%, furniture and home stores down 67%, and clothing and accessories down 89%. Well, an awful lot of those places were closed. Consumers were staying home. And one thing that happens in recessions generally is that people stop buying durable goods. And, you've got durable goods. You can make them last for another month, another quarter, even another year. Food you keep buying, obviously, because you use it up week by week. Electronics, well, you can stay home. You don't have to buy that. And we see that as usual. here. Notice food and drinking services and drinking places, the restaurants down 49%. So they had some carry out, they had some delivery, but in-store sales way down, of course, since most of them were closed. Notice, however, there's something else going on here. In Indiana, at any rate, the motor vehicle and parts stores, so these are auto dealers and the motor vehicle parts stores and gasoline stations, those were essential businesses. Most of those remained open, and yet take a look, sales down 33% for motor vehicle and parts, sales down 43% for gasoline stations. Of course, that's partly the price decline, but we know that gasoline sales declined as well. So big drops of consumer spending, even on those things that you were allowed to go out and buy, and even on those things where the stores stayed open. So something else is going on out there, and I think that what's going on is people were just scared to go out. You could go out and step out into the world and risk catching a very deadly disease. And so consumer sales down across the board other than grocery stores and online. What about inflation? Well, this is also revealing as to what's going on. And this is the core inflation rate. And the core inflation rate takes out food and energy. And food and energy, energy mainly gasoline prices. Food and energy are the most volatile of the prices. And so in order to figure out what's going on in the underlying economy, apart from variations in weather and Middle Eastern politics that tend to affect food and energy prices, apart from that, what's going on in the economy? And we use the core rate for that. And what we see is that the core inflation rate was 2.7% in February. It's been up and down within about a point of 2% annually for more than 20 years. It's been very stable, up and down around 20. What happened in March? Minus 1.2. What happened in April? Minus 5.2. And you know, we've got core inflation rate measures all the way back to 1957. And in that entire period of time, there have only been 11 months in 57 years where there was any deflation at all, and 2 of them are our most recent months. This is deflation. This is not low inflation. This is actual falling prices. And the reason I emphasize this, the reason I think this is revealing, is because one of the questions that economists at least asked is, what's causing this recession? Is it mainly a supply shock or a demand shock? And by supply shock, we mean, hey, we had supply chain problems coming through China back in January and February, and then hitting us as well in March. We had workers staying home because they were sick. We had businesses being closed. We had workers staying home because they were told to stay home. Those would create shortages, and of course there were some shortages. But if that was the source of the recession, then prices would have gone up, then inflation would have gone up, as happened in the supply shocks back in the 1970s and the one back in 1991 related to the Gulf War. All of a sudden, gasoline was in short supply, gasoline-related products were in short supply, and prices went up as consumers were desperate to buy stuff and bid prices up. But that's not what's happening here. Sure, there have been a few shortages, but those shortages were caused mainly by excess demand, by people panic buying, hoarding, stocking up. What's actually happening out there is that shoppers are shopping less, consumers are buying less, and that is driving prices down. Businesses desperate to find customers and therefore not raising prices and even putting things on sale. So we've got deflation demonstrating that consumers and consumer spending and the drop of consumer spending and the drop of consumers' willingness to buy stuff, that's the source, the main source of this recession. Well, what are we doing about the recession? One of the things, of course, was the CARES Act and the associated increases in federal spending. And an earlier report from the Congressional Budget Office back in April, it wasn't really a report, it was actually just a blog post from the CBO. One of the reasons they do their economic forecast, the main reason they do their economic forecast, is to try to predict what's going to happen to the federal budget, what's happening to revenues, what's happening to spending. And Congress uses that as a guide to what they can do with their appropriations. And they came up with an estimate that the deficit, these expenditures above revenues in fiscal year 2020, which ends at the end of September this year, will be $3.7 trillion. $3.7 trillion. Now, as a percentage of GDP, that would be 18%, a deficit equal to 18% of GDP. Now, it's been running in the neighborhood of 5, between 2.5 and 5 over the last couple of years. Minus 18 would be a very large increase. You notice that this is the longest time series I'm going to show you here. This goes from 1929 to the present, and I put that in there so you could see World War II. And you can see the great big deficits that we ran in World War II. Now, there's a couple of different ways of measuring the budget balance. The CBO has one way. The National Income and Product accounts, the GDP accounts, have another way. What you're looking at here is the annual GDP account number, and they've got the federal budget deficit during World War II topping out at a little less than 15%. CBO's got other measures that put it at about 25. But at any rate, what we're looking at with minus 18 here is the kind of deficit that we ran during World War II. So in a sense, this COVID crisis is a crisis on the level, on the size that World War II was for the United States. Of course, World War II went on, well, we hope, a lot longer than the COVID crisis will last. But at any rate, that's what we're looking at. A very, very large budget deficit. Now, you might think, wait a minute, $3.7 trillion, that means we got to issue $3.7 trillion in Treasury bonds. Who the heck is going to buy $3.7 trillion in Treasury bonds? Surely, in order to borrow that much money, we're going to have to offer high interest rates just to attract money lending from all the other things that lenders might want to lend money for to get them to buy Treasury bonds. You might think that Treasury bond interest rates would have to go up, but you and I would be wrong. Because, in fact, Treasury bond interest rates are not only going down, they are down lower than they have ever been. Back on February 19th, now these are daily rates, and one of the great things about financial market data is you get them every day, and so they are absolutely up to date. Back on February 19th, the 10-year Treasury bond interest rate, that is the rate we had to pay people to lend the federal government money for 10 years, that is, the money gets paid back 10 years from now, was 1.56%. And by March 9th, less than 3 weeks later, it was 0.54%. And here on May 14th, most recent number when I made this chart, it was 0.63%. Now, if you think about it, over the next 10 years, the inflation rate's probably going to be about 2. That's what people would expect, which means that the money that the federal government will pay back plus interest 10 years from now will be worth less in terms of what it can buy relative to prices than the money that got lent. In other words, people are paying the federal government to take their money. That's really astounding. Over a 10-year period. Now, that happens every once in a while for short-term debt, but for a 10-year Treasury bond to have a negative real interest rate, this is astounding. And what it tells you is that people out there, lenders out there, are scared. They can't think of anybody else they'd rather lend to than the federal government because they know at the very least the money will be paid back. The Treasury bonds, U.S. Treasury bonds, are the most secure assets in the whole world, the least risky assets in the whole world. If you want to guarantee that your money will be safe, you buy Treasury bonds. And even if you buy bonds from, AAA corporations, there's always that chance that you're not going to get paid back. And so money tends to flow to Treasury bonds looking for safe assets. It's an indication that financial markets are concerned about what's going on out there. Well, what it also means is that, yes, we're going to be borrowing a whole ton of money over the next couple of years, the federal government is, but we're going to be borrowing it very, very cheaply. Well, speaking of interest rates, what about the Federal Reserve? What's the Federal Reserve been doing? And my goodness, the Federal Reserve has been extremely aggressive even compared to what we thought was really aggressive during the Great Recession. We've never seen the Fed act as fast and as big as they have over the last couple of months. The federal funds rate is the policy interest rate of the Federal Reserve. And so it's an indicator as to what they do, what they're trying to make interest rates do nationwide. And on March 3rd of 2020, or at the morning of March 3rd in 2020, the interest rate that they had was averaged at 2.25%, as you can see. And by March 15th, it was down to 0.25. They pushed that interest rate all the way down to as close to zero as they can get. In just 2 weeks, they knocked 1.5 points off of that federal funds rate. And that is the fastest that they have ever done. Okay, so excuse me, the rate at the beginning on March 2nd was 1.75. It was 2.25 earlier at the end of 2019. So a big 1.5 point cut in less than 2 weeks, and that is the biggest 2-week reduction the Federal Reserve has ever done in its 100-plus year history. So very, very aggressive. And furthermore, now that they're down to zero, they've kind of spent their ammunition on the federal funds, but they have reopened an awful lot of other programs that they use to lend money to all kinds of people, programs that were invented during the Great Recession when they also drove the federal funds rate down to zero. So very, very aggressive by the Federal Reserve in an attempt to keep financial markets stable, keep financial markets lending. Now, in the Great Recession, financial markets shut down, right? Lending stopped for a little while. There was panic. We haven't got panic this time. And another thing to remember about the Fed, and I think people sometimes get confused about what the Fed is doing, these are not bailouts. This is lending. All the money that the Fed is lending is going to get paid back, or most of it's going to get paid back. Of course, sometimes loans default, but most of this money is going to get paid back. These are loans in an attempt to keep financial markets, keep lenders whole, so they don't do awful things like stop lending on mortgages because they don't have enough in reserve and they're afraid that the people are going to withdraw money from their institutions, or afraid that they're not going to be able to get loans themselves to pay off their depositors. This is to keep lenders whole so that we don't add financial market panic to the rest of our problems. Now, early on, it looked like there might just be a financial market panic. And one of the hallmarks of financial market panic is that interest rates spike upward. And these are the corporate bond interest rates, and they're AAA and BAA. And AAA are those that Moody's, the bond rating agency, rates as a very low risk. That is, this is Microsoft, right? You lend to Microsoft, you're going to get paid back. There's no problem there. BAA corporations, though, are a little iffier and a little riskier. You can lend money to these folks and, oh, sure, you'll probably get paid back, but maybe not. And so in order to borrow money, BAA corporations have to pay higher interest rates. They have to compensate lenders for this added risk. And so you see the BAA rates, interest rates, higher than the AAA rates. Well, you see the last year's worth of rates right there. And between March 6th and March 20th, so over that 2-week period, as the coronavirus, as it became clear that we really had a problem here, the rates spiked upward, as you can see. And that, as I said, is a hallmark of financial market crisis. When lenders get really concerned or panicky, they stop lending. And so in order to borrow any money at all, you got to offer them high interest rates. They think everybody is risky. Even AAA corporations are thought to be risky. A lot of what's happening here is they're switching money into Treasury bonds and not lending to the private sector at all. Well, it spiked upward. And then after that, it came down. And take a look at the AAA rate right there. Came down to actually lower than it had been in 2019. So your least risky corporations are having a wonderful time borrowing money in financial markets. The BAA rates are back down to where they were in 2019. Now, the difference between the two is greater than it was. We'll talk about that here in a sec. But what happened was the financial panic, the gathering financial panic stopped, and the panic disappeared. Now, people are still a little pessimistic, of course, but the panic was headed off. And who did that? The Fed did that. That's what I think the Fed deserves credit for, the fact that we are not also dealing with financial panic on top of everything else that's going on. Now, here's just to compare what happened this time to what happened during the Great Recession. I've got an interest rate spread here, and that's just the difference between the BAA and the AAA corporate bond yield. And it's a really good measure of how confident or pessimistic financial markets are. Because if you become pessimistic, one of the things that lenders do is to quit lending to more risky corporations and start lending to less risky corporations. They shift their lending from BAA to AAA. And that means that the BAA interest rate goes up more than the AAA interest rate goes up. And we saw that that happened. And then when it came back down, AAA interest rate came way down, BAA interest rate came down, but not quite as far. So the differential goes up. And we've got these numbers, these interest rate numbers, all the way back to 1919. So we can compare what's happening now to what's happened over the last century, an entire 100 years. So we can tell when were financial markets particularly panicky over the last century and when are they not. Well, what you see there is that as of May 11th, the differential is 1.5%, 1.5%. It came down from about 2 on April 7th, so over the last month it's come down. 1.5% is pessimistic, you might call it concerned, but compare that to what happened during the Great Recession when the spread went up to 3.5. That was the highest corporate bond spread since the 1930s. And so to say that the Great Recession, the financial market panic in the Great Recession was the worst since the Great Depression, well, there's your evidence right there. It was. What we see right now at 1.99, much less panicky than during the Great Recession. And at 1.5, well, we're about as concerned as we were during that sort of mini slowdown that we had in 2016 or during 2012 when Congress couldn't pass the budget and there was some concern that we could default on some Treasury bonds. That's the level of concern we've got right now. This is not, and this is nice to be able to say, financial markets are not in the worst crisis since the Great Depression. We've got a lot of things that are the worst since the Great Depression, but not what's going on in financial markets. And again, Federal Reserve is the one who's pulled that off, who's made that happen, in my opinion. All right, well, what about foreign markets? What about foreign exchange? Let's see what's happening in the United States relative to the rest of the world. And the exchange value of the dollar can tell us something about that. This is an index of the exchange value of the dollar. So it's like a price index, only a price index of exchange rates. And the weights are based on how much trade we've got relative to other countries. So our trade with Canada and China and Mexico and Europe play large in this thing. So the exchange rate with the Canadian dollar and the Mexican peso and European euro, Chinese yuan is heavily reflected in this index. And our trade with I don't know, Poland and Thailand matter a little bit less than the other countries. Well, what we see is a trend upward in the exchange value of the dollar over the last decade, but we also see is a spike upward from March 3rd to March 23rd. So again, when it became clear that the coronavirus was going to have major impacts on our economy, one of the things that happened is the value of the dollar went up. Now, why does that happen? When the United States is plunging into recession, why would people want to buy dollars? And the answer is, once again, Treasury bonds. This is a crisis affecting the whole world. When crises affect the whole world, lenders and investors and just people with money that they've got to park somewhere look to Treasury bonds. Right? They want to say, hey, let's keep our money safe. Even if we can't get a decent return on our money, let's keep it safe. Let's buy Treasury bonds. Well, if you're in the rest of the world and you want to buy Treasury bonds, first you have to buy dollars. First you have to trade your currency for dollars. So if we're seeking Treasury bonds as what's called a safe haven, we got to have dollars. Demand for the dollar goes up, and that drives up the value of the dollar. So it went up 8.5% between March 3rd and March 23rd, and it's come down since then, but it's still 5.5% higher, 5.4% higher now than it was 2 months ago. So the exchange value of the dollar up, indicating again that one way that we are financing this great big budget deficit is by borrowing from people all over the world. So one reason that interest rates have gone down is that people with wealth, people with money to lend everywhere in the world are lending that money to us so we can support our federal budget deficit. All right, well, let's take a look at what the recovery might look like. And this is one of the reasons why I emphasize the consumer spending thing, was because if the recession is because of a drop in consumer spending, the recovery requires that consumers start to spend. So let's take a look at the prospects for a recovery of consumer spending. Well, this is an index of consumer confidence, and this is one is done by the OECD, which is the Organization of Economic Cooperation and Development, which is an international organization of bigger economies. And we see that they do a survey, just like the University of Michigan, and that one gets more publicity, but the FRED data source, Federal Reserve Economic Data, has the up-to-date information from the OECD, so here it is. And we see, of course, just what you'd expect, a rather large plunge in consumer confidence in the United States, back down to where it was back in 2012, where we still were struggling out of the Great Recession. And probably we'll see another plunge in May. So consumer confidence is down. Didn't really need to be told that, but there's some evidence for that. Here's another kind of survey, though, and I thought I would just give you this newspaper article because I think it's very really revealing again about why consumers are not spending. And this is a survey reported on April 28th, done by Reuters and a survey organization called Ipsos. And the headline, let me read it to you. The headline says, most Americans to avoid sports, other live events before coronavirus vaccine. Fewer than half of Americans plan to go to sports events, concerts, movies, and amusement parks, that is, consumption that requires a crowd, when they reopen to the public until there is a proven coronavirus vaccine, according to the survey. Only about 4 in 10 who follow sports avidly or who go to arts and entertainment venues like movies or amusement parks said that they would do so again if they reopened before the vaccine was available. So here we go. We can reopen these places. We can say, hey, go to movies. Hey, baseball's reopened. Hey, amusement parks are reopened. More than half of Americans say they're not going to go, even if they're open, until we have a vaccine. All right, so what does that tell you? That tells me that it's the virus that's causing this recession. Yes, we shut down the economy, but the virus has caused the recession. Why did consumer spending fall? Well, to know when we're going to recover, we have to know, why did consumer spending fall? Was it lack of income due to lost jobs? Certainly that played a role. If so, spending will recover when people go back to work, if their jobs survive. That is, if the businesses they work for survive. And also, you got to worry a little bit about if we're reopening a restaurant at 50% capacity, maybe you only need 50% of the wait staff. That's a problem as well. If consumer spending fell because of stay-at-home orders, you know, you can't spend if you can't go shopping, and you can't go shopping if you've been told to stay at home, then spending recovers when stay-at-home orders are lifted, as they are being lifted. Unless, of course, household savings are depleted and households are in debt. So here's the problem. In order to survive over the 2 months that you couldn't work and continue not to work, you had to spend your savings, you had to go into debt. Now you're working again, maybe earning some income. Do you start to spend right away? Well, no. Got to pay off the debts from before. Got to replenish my nest egg, you know, increase my savings. That may delay spending. Now, the CARES Act spending, that $1,200 per person and the extra $600 a week for the unemployment insurance, that was designed to stop this from happening. That is, to keep consumers whole so that when the virus allowed us to go back out and shop, people would be able to do it. And you know, whether the CARES Act worked or not is a good question. There's at least some evidence that the unemployment insurance, the extra $600, really did the trick. We'll find out as we move forward. But that was the idea there. And we are hoping that consumers will have the wherewithal to spend once they get their jobs back. However, if consumers didn't spend because they were afraid of getting sick, especially consuming in a crowd, if you're afraid of getting sick, then spending will recover only when confidence returns, only when the virus threat has lessened and consumers believe they are safe going out shopping. And if you think about it, lots of consumers are going to have to feel safe. You might say, well, you know, half of all consumers feel safe and they're going out. Well, if half consumers don't feel safe, you're not going to recover. You got to get 95% of all consumers feeling safe to get back to anything like where we were at the beginning of this year. So that tells you how this recovery is going to go. And here's an important thing to say, I think, when we're talking about recession and recovery. When economists talk about recession, we mean the period when economic activity is falling. So the recession began in March, continued in April, probably in May, but we may see the recovery begin in June or July, and certainly by the third quarter, August, September, October, or July, August, September. The Congressional Budget Office has the economy dropping in the second quarter, but recovering, growing at an annual rate of 20%, in fact, in the third quarter. And so, you know, economists may announce, hey, the recession is over. We don't mean that everything's okay. If you think about it, if you define the recession as the downward portion of the business cycle and the recovery as the upward portion of the business cycle, the last day of recovery and the first day of recession, or the last day of recession and the first day of recovery, those are your two worst days. We're going to be recovering in the second half of 2020 and through 2021, but we're still going to be in the hole. Right? So we'll have growth in economic activity probably fairly soon, unless we have a resurgence. Always the caveat there. If we have a resurgence, then we shut down again and we're right back to square one. But level of activity remains below normal even as we're recovering. That is, we'll have positive real GDP growth, but with high unemployment all the way into 2021 and maybe beyond. Congressional Budget Office says GDP grows starting in the third quarter, but the unemployment rate by the end of 2021 is still over 8%, still at recession levels. That's what we're likely to experience. Now, back when I was young and naive 2 months ago, I thought, hey, maybe we can have a V-shaped recession and recovery, sharp, big downturn, sharp, big upturn again. It's over in a few months and we're back to normal. That's not going to happen. I think we know that's not going to happen now, right? Since it depends on consumer confidence, and consumer confidence is not simply going to recover. When I was young and naive, I guess I imagined VV Day, right? Victory over virus day. We declare, hey, it's over. We go out and have a party in the streets, and then we start spending again. Well, that's not going to happen. U-shaped, sometimes you say maybe the recession recovery will be U-shaped, but we know that the first half of that U was more like a V, right? It was a drop off the table, not a gradual decline. L-shaped, bite your tongue, you know, L-shaped, that's the Great Depression, right? You go down and you stay down for years at a time. What we're thinking right now, and what the Congressional Budget Office is projecting and others are projecting as well, is a check-shaped recession and recovery. Sometimes you see swoosh shaped. I think that violates trademark, so let's not do that. But a check shaped recession and recovery, sharp downturn, we already know that's possible. And then a long, years long recovery. And I think that's what we're going to see. Right? And the recovery, again, years long, because how long will it take to get the vaccine? How long will it take to reestablish consumer confidence? Sooner we get the vaccine, the better. Sooner we get the virus under control, the better. But that's not going to happen overnight. So that's what we're looking at here. Recession and recovery, check-shaped. All right, well, we've got some Indiana evidence now about how bad this thing is. Let's take a look at the April revenue report from our state budget agency. And so we got some numbers from the April report, and you can find this on the State Budget Agency's website. And what I thought I would do is compare it to the December forecast, not compare it to what it was in March, or not compare it to what it had been the previous April, but compare it to forecast. And the reason I think that's the best way to do it is the forecast revenue. That's what we based the budget on. Now, we based it actually on the April forecast from last year. But you know, when we wrote the budget for this fiscal year and next fiscal year for 2020 and 2021, we based it on how much revenue we thought we would have. And so that's how we based appropriations. And as long as we get that revenue, we can fulfill the budget. We can spend those appropriations. But if we fall short of forecast, then we fall short of the revenue required to fund the budget, and we may not be able to spend all of the appropriations. And so let's take a look at the revenue collected in April compared to the forecast revision that was done in December. For sales taxes, we collected $606 million. We expected to see $710 million in the month of April. That's a 15% shortfall, $104 million short. So 15% decline. Okay, makes sense. We saw that retail sales were down 22%. So 15%, something like that. Sales tax covers more than just retail sales, covers an awful lot of business-to-business sales. Perhaps those weren't down quite as much as retail sales were, but at any rate, sales tax revenue down 15%. Individual income tax and corporate income tax, now those are down by incredible amounts, 58% and 65%, collecting less than half of what was expected. And April's the big month for the income taxes. Of course. Well, and that tells you why, right? This is not only a decline in income, that is a decline in income tax withholding, but it's also the result of the postponement of the delay of the due date for income tax payments, delayed from April 15th to July 15th. IRS did it, or the federal government did it for federal income taxes, and we did it, we matched that for the state income taxes. So one hopes that an awful lot of that money, an awful lot of that $669 million in individual income taxes that we didn't collect will eventually be collected in May and June and July. And that will end up being down, like 15%, something like sales taxes are down. So we'll see about that, but that is certainly the hope. And I'll give you an idea as to why that's a hope here in a minute. Wagering, casinos and racinos were closed. That was down 100%. We didn't collect any revenue from that. Other taxes, that's a cigarette, alcoholic beverage, insurance, interest earnings, down 7%. In total, we're off 44%. That is, we collected $964 million less than we expected just in April. Can we handle that? Well, we got to look at balances then, right? And this is the chart that the budget agency puts together, or the data, a chart from the data, at least, that the budget agency puts together. And we got the data that's back to 1976. And you see that that purple stripe there at 10 to 12%, and that's what the budget agency calls the prudent range. And that's where we would like to be in order to handle potential recessions, in order to handle temporary revenue shortfalls. I've also got there a line at 5%, which I've always called the rule of thumb minimum. And the reason you need to have 5% balances is because of cash flow. Expenditures go out on a different schedule that revenues come in, and so you need some balances in your account to handle that. 5% is what the public finance biz says states should have, and that's the number that Indiana has always adhered to. 2004, it got down to 4.9, but that's the lowest it's ever been. 5% of the budget, that is, 5% of total revenues or total expenditures at the end of 2020 would be about $850 million. We expected to have in balances $2.4 billion, 13.9% of the budget of revenues at the end of 2020. And so that means we've got about $1.6, $1.7 billion to play with, to use in case there's a revenue shortfall. So let's use the number 1.6 billion. Keep that in mind. How much did we fall short? 964. That's more than half of what's available to cover revenue shortfalls. And what it shows you is, if this is permanent, if the income tax and corporate income tax declines are really declines and not just payment delays, we're done. Basically, we'll have run out of balances, usable balances, 1.6 billion by the end of this week, for goodness sakes, if that continued into May. And boy, what this tells me is that there isn't a state in this country that can handle a 44% decline in revenues for more than a month or two or three. I don't care how well run you are. I don't care how big your balances are. If that's the size of this shortfall, we're all done. Basically, and you know, I say that in advance of talking about what the federal government needs to do about this. But let's take something a little, let's have a good thought. Let's be a little optimistic and say that the decline in the income tax was mostly payment delays. Let's try 15%. Let's say a 15% decline. How long will balances last if revenues fall short by 15% month after month after month? And here's the arithmetic on that. So again, but suppose total revenue falls short of forecast by 15% per month. Now, I just took the total amount of revenues and divided it by 4 to come up with the first quarter there, April and June, really the last quarter of fiscal year 2020. And the revenue forecast would have been $4,264 million. And of course, there's variations in collections by month, but let's just keep it simple. Shortfall during the last quarter then, if it was 15%, would have been $640 million. And that implies that we're going to make up some of that $964 million shortfall in April as people begin to pay their income tax. So suppose we're down by $640 million by the end of the year. We expected to have imbalances $2,370 million. If we're $640 million short, we will have $1,730 million. But that's only $854 million above the 5% million. So we'd have $854 million left to cover shortfalls. If the average monthly accepted revenue in 2021 is $1,460, 15% of that is $219 million. And that means that the balance we have at the beginning of fiscal year 2021 is enough to handle 4 months of 15% shortfall. Balances run out at the end of October, 4 months into the fiscal year. Again, Indiana is a well-run state financially, AAA rating, pretty good balances relative to the size. We're in the top third among the states, and yet we can last at this rate at 15% only till the end of October. What happens then if we're out of balances and if revenue shortfalls continue? What happens then? Well, let's look back to see what happened last time. And so in a bunch of cases here, I've dredged up old charts and then updated old charts that I had from back in the Great Recession when we were trying to explain what was going on and understand what was going on back then. And so this is the chart from back then. And the red line is appropriations, so that's the budget. And the green line is Indiana own source revenue. So that's sales taxes, income taxes, corporate income taxes, wagering revenue, other revenue, general fund revenue, right, from Indiana owned sources. And from 2009 to 2011, the period when the Great Recession affected the budget, the 3-year shortfall was $4.6 billion, which was about 11% per year, lasting for 3 years. So that's something like our 15% assumption there. And it says that what's happening now is worse than that, but that lasted for 3 years, and we hope that doesn't happen this time. So what did we do about that? We didn't have $4.6 billion in balances to cover that. What did we do? Well, here's 2 more lines and a bunch more numbers on this chart. And so take a look at the extra lines I've stuck on there. You've got that red dotted line, and it's under appropriations. And that's because it's appropriations less reversions. So one of the things that happens once you run short of balances and revenues are still falling short is we get reversions. And what that is basically the governor saying, yes, I know we've got this level of appropriations, we're going to spend less than appropriations. And over the 3 years, they reverted, that is, the money that you don't spend on appropriations reverts to the general fund balances. we cut spending by $2 billion, which was an average of 4.5% per year. So appropriations going out to K through 12 education, for example, they say, sorry, you'll only get 95%, 96% of what we promised you, $2 billion in reversions. So we cut spending. That's one of the things that we do. Another thing that happened was, if you take a look at the green dotted line, that's the ARRA, the American Recovery and Reinvestment Act, or maybe Reinvestment and Recovery Act. I forget which is which, but that's the federal aid that came from the federal government to the states to fill in budget gaps. We did that the last time, and it was $2.2 billion. And if you take a look at the original gap between appropriations and own source revenues, you can see that it was almost filled in by a combination of spending cuts from reversions and federal aid. $4.2 billion out of the 4.6 came from reversions and federal aid. The rest of it covered by using some balances and by some fund transfers from other funds into the general fund. So that's what we would expect to happen. We would expect spending cuts once we're out of balances, if revenue shortfalls continue. But we're also really hoping that, like the last time, this time we get some general revenue aid from the federal government. Now, the House of Representatives have passed such a bill. The Senate is, what would you call it? Reluctant, I guess, to do that. You know, again, as I said before, a 15% decline, let alone a 44% decline. This is not a blue state, red state issue. Every state, well-run or not so well-run, run by Republicans, run by Democrats, it doesn't make any difference. No state can stand up to an extended shortfall of 15% per month. And one hopes that the governors of the states let their senators know that, yeah, we may be very well run, but we can't take this either. So that's what we're hoping. We're really hoping for several $billion in aid coming to Indiana from the federal government. And without that, the reversions will have to be really quite severe after October, if we're doing 15% decline. Now, the Congressional Budget Office forecast has consumption falling short for the next 2 years, falling short about 8%, so only half of 15%. And if that's the case, hey, balances will last until February. So there you go. How about local governments? You know, state government is affected right away by a recession. Right? The income tax withholding drops off as unemployment goes up. Sales taxes drop off as consumer spending declines. That's not quite true or as true for local governments. With local governments, there's a lag for when the recession will actually hit local government revenue. So let's talk about that lag. Let's start with the property tax. And I'm looking back again, dredging up old figures, maps and charts from the Great Recession. But this is the average annual percent change in gross assessed value from pay 2010, that is from the tax payments from 2010 to the tax payments in 2013. Now, think about tax payments in 2010. Tax payments in 2010, the tax bills, were based on the assessments from 2009. And the assessments in 2009 were based on the property values from 2008. So the recession hits in 2008, home construction drops off, businesses don't purchase equipment, home values and property values go down. That is reflected in trending with assessments in 2009, and that is affected in tax billing in 2010. And so with a 2-year lag, we expect the effect of this recession on property values and expenditures on property and home construction and so forth. Here in 2020, we expect the assessors to pick that up in assessments in 2021, which will then affect tax billing in 2022. 2-year lag. 2022 is the year that the property tax will reflect what's going on in the recession right now. Boy, gives you an idea as to why federal aid right now would be so welcome if we could have federal aid that would help local governments as well as state governments, it would mean that maybe we don't have to face that revenue shortfall in 2022. Because think about what's happened. By 2022, we hope to be recovering. But what happens? All of a sudden, revenues fall short for local governments, for cities and towns and schools in 2022. And all of a sudden, they're laying off people who then have to cut back on their spending. They're increasing the unemployment just at the time that we're trying to get the economy recovering. Right? This is the sort of thing that we're looking for from that hoped for federal aid. But at any rate, look at that map. All the red counties saw declines in gross assessed value. The yellow counties there saw increases of less than 1%. So more than half of the counties, about 2/3 of the counties from 2010 to 2013, this is the average over that whole period. So this is 3 years, saw decreases in gross assessed value, before deductions, gross assessed value. And so it is possible under our property tax system, market value in use plus trending, for the property tax base, the thing we tax from the property tax, to decline after recessions, but with a lag, affecting revenues with a lag. Okay, so that's what will happen in to assess values for the tax year 2022. What will happen to levies? Well, that depends in part on what happens to the maximum levy growth quotient, the MLGQ. And here's a chart on how we calculate the maximum levy growth quotient. Of course, maximum levy growth quotient tells you how much you can raise your maximum levy from one year to the next. And it's based on the average growth rate of Indiana non-farm personal income, and that's what the blue bars show you, averaged over 6 years. So what happens? This year, we see a decline in income. We're expecting that to happen. The decline in income this year will be measured by the U.S. Department of Commerce by the middle of next year. So by the middle of next year, we'll know what happened this year. And that will be incorporated into the maximum levy growth quotient calculation, the 6-year average, the year after that for 2022. So once again, 2022 is the year when we're going to see the decline in the maximum levy growth quotient. Now you can see that happened back in the Great Recession. Great Recession, we had that one negative bar there in 2009, and that entered into the MLGQ, which is measured by the red line right there. That entered into the MLGQ in 2011. You can see it dropped from about 4 to about 3, and then it stayed under 3 for 6 years until that 2009 number finally dropped out of the 6-year average in 2017. And so because of the way our MLGQ works, if we have a big negative year, it stays in the calculation for the next 6 years. Well, what's going to happen in 2021? We've already got a really good idea on that because we've got the data that's going to be put into this number. We know, we've already seen reported all 4 quarters of Indiana state income in 2019, and 2019 is going to be added in for the maximum levy growth quotient for 2021, for budgets in 2021. And it looks like it's going to be about 4.2. Now, there's going to be one more revision in these numbers, and that takes place on June 23rd. So after June 23rd, the budget agency will make the calculation, and it'll come out somewhere in the neighborhood of 4.2, 4.0, 4.1, 4.2, 4.3, 4.4, somewhere in there is what we expect to see. We know it's going to go up from the 3.5 this year because we're dropping out a near zero number in 2013 and adding in a number that's going to be something like 4%. So we know it's going to go up. But what happens after that? So here's a chart that tries to guess at what could happen to the maximum levy growth quotient for 2022. All right, maximum levy growth quotient, I should say 2022 up there. Given a whole bunch of different possible changes in income here in 2020. So we're going to get a drop in income in 2020. What will happen when we add that into the 6-year average in 2022, knowing that we've got 4 numbers we already know for sure, the 2019 number that we pretty much know for sure. What happens when we add a new number into those 5 numbers we already know? And you see the possibilities. Now, what's going to happen to non-farm personal income growth? probably in the neighborhood of -2, -4, -6 is probably what we'll see. Congressional Budget Office is saying U.S. personal income is going to decline by 2%, so a -2 from them. We're a little more volatile as an economy here in Indiana, so maybe we're -4. We'll see. But in that neighborhood is where you expect to be. And if we put that number into the 6-year average, you'll see that the maximum levy growth quotient ends up being somewhere in the neighborhood of 2.3 to 3%. So down into the twos, again, just like last time. And as it turns out, if we recover to 4% starting in 2021, 4% growth in personal income, these numbers are also the kinds of numbers that we'll see over the next 6 years until the 2020 number finally drops out in 2027. So that's what we expect. Well, what will that do to property tax revenues? Because, okay, how are property tax revenues affected? Well, for one thing, the maximum levy growth quotient will limit the increase from 4% to 3%, or maybe a little less than 3%. So we know that happens in 2022. But what about tax cap credits? Because if assessed value goes down, suppose it goes down 2%, just to pick a number, and the maximum levy goes up, suppose it goes up 3%, just to pick a number, that means rates will rise 5%. Down 2%, up 5%. Suppose your rate is $3. That is the rate in your taxing district, the county plus the city and town plus the school plus the township plus the library district and so forth, adds up to $3, a relatively high rate. That would be 5% of $3. That would be a 15-cent increase. If your tax rate goes up by 15 cents, more of your taxpayers will be eligible for tax cap credits, and they'll be eligible for more tax cap credits, which means you'll collect a smaller share of that maximum levy. Question is, how much smaller? And that's what this chart tries to come up with. I compared the tax district rates and tax cap credit losses as a percentage of the levy in 2018 and 2019 for the 2,000 or so taxing districts that we've got. And so what you see across the bottom there, the horizontal axis, is the change in tax cap credits between 18 and 19 for all these taxing districts. And what you see along the vertical axis is the change in the tax rate. So what happens if it goes up by 15 to 20 cents, the second to top row up there? You see 3 different bars. The green bar says, what if your initial rate is under $2? Well, if your rate's under $2, you're not really subject to much in the way of tax cap credit losses because hardly any of your taxpayers are eligible. And so if you go up from a rate of 1.5 to $1.50 to $1.60, nothing much happens. Right? If your rate is between $2 and $3, that's the gray bar, then more of your taxpayers are eligible. And if your rate is over $3, then you've got the biggest problem. Then most of your taxpayers are eligible for tax cap credits, or at least potentially eligible for tax cap credits. And so if your rate goes up 15 cents, you could see an increase in your tax cap credit losses as a percentage of your levy of about 2.5%. So what do we got? We got your maximum levy rising 3. We got your tax cap credits going up 2.5. It means you've erased much of your increase in the levy. Now, it's not going to reduce levy collection. So I think in general, the impact of the recession will not be enough to send property tax revenues downward, but it will certainly reduce the growth. And if your tax rate is above $3, reduce the growth by quite a bit, potentially. And that's especially true if your assessed value goes down. So it depends on a lot of things, depends on how much assessed value goes down, depends on the maximum levy growth quotient, depends on the starting point, what is your initial tax rate in the taxing districts in which you're located, depends on all of that stuff. But the recession will have an impact in 2022 on local government revenues, reducing growth for the most part in revenues from the property tax. What about the local income tax? Well, local income tax, a couple of things to say about that. Let's think about how the local income tax works, all right? It is not the case, unlike the state, it is not the case that the shortfall in income tax withholding that is happening right now is going to affect local governments. local government, local income tax distributions were set by October last year, and you're going to get that money. So that's not going to affect us now. So what will be the effect? Well, the income this year will be down. Next year, that will be reflected on people's W-2 forms. And so they will pay taxes next year based on their lower income this year. Tax collections through the middle of next year, through June 30th, in each county will be based on income this year. Those tax collections will be the basis for the distribution of local income taxes to local governments the year after that, in 2022. Again, a 2-year lag. The decline in incomes this year will affect income tax distributions in 2022. So, year and a half again before we see the big income effect. But there's a possible longer run effect, and that's what this map is about. You may remember, if you were around in local government 10, 12 years ago, that we've got this thing where most of the time collections and actually most of the time collections are higher than distributions. We set distributions in advance, and then we depend on collections to come in at that amount. But when there's a recession, collections fall short of the distribution, and sometimes they fall so far short that the balances that each county has in their state account goes from positive to negative. That is, we actually distribute more money than has been collected. And that happened the last time, and what you see here is balances as a percent of distributions in 2010 as a percent of 2012 distributions, and you can see an awful lot of red and an awful lot of pink on there. More than half the counties had negative balances. Now, what happens when we have negative balances? The state then limits the distributions until balances are made up. That is, they hold distributions well below collections for as long as it takes to build balances back up. And you can see that income tax distributions 2011 to 2012 grew less than 1% in about 1/3 of the counties, even though the recession was over and collections were growing again. Well, is that going to happen again? We've got a system that is designed to try to prevent that from happening, but the system was invented on the assumption that the Great Recession was as bad as recessions get, and well, maybe not. Let's take a look at Elkhart County and see what balances, collections, and distributions did in Elkhart County back in the day. And I pick on Elkhart because Elkhart County has the most volatile economy in the state and one of the most volatile economies in the whole country. Back during the Great Recession, their unemployment rate went up to 20%. And of course, it's the RV industry. And if you think about it, the first thing the consumers cut back on when there's a recession is durable goods, high-priced durable goods, luxury durable goods. RVs are the first to go. So RVs very sensitive to recessions. So what happened? Well, take a look at the green line. The green line is tax collections. You can see a fall from almost 60 to almost 40, so a very large reduction in income tax collections in Elkhart County. However, distributions, total distributions, as you can see the black line there, total distributions above collections for 3 years, 2008, 2009, and 2010, distributions set in advance of collections. So we say, hey, we'll distribute this money to you thinking we're going to get the money collected. Turns out not. And that, as you see on the red line, drove balances into negative territory. So then what happened? Well, look at distributions from 2010, 11, 12, 13, they stayed low. Even though collections began to recover in 2010, distributions stayed well under collections for some time after that. And this means that the recession that happens this year could cause a shortfall in revenue from what might be expected, distributions below collections on past 2022, 2023, 2024, if balances go negative. Now, we hope they don't. We hope collections begin to recover soon, But should that happen, one should be aware that local income tax distributions could be down for some time to come as well, after the first time they'll be affected in 2022. All right, so that's basically what I've got to say about all this, and don't you think that's enough? We're going to turn it over to you, and you've got a handout called 10 Threats to Local Government Revenues from the Corona Recession. I've talked about most of these, but let me at least run down the list, let you know what you've got on that handout. The first entry is short-run property tax, and that has to do with the fact that the penalties for the property tax payment have been delayed, and so we may get a delay in property tax payments. The June distribution may be lower than usual, and therefore we may have some cash flow problems. Property tax medium run, that's the 2022 effect we talked about. Property tax longer run is the maximum levy growth quotient being lower for all the way out to 2027. Local income tax short run, collections delay, meaning that we collect income taxes through June 30th, and that sets the distribution for 2021. But what if people don't pay their taxes until after that date? Could reduce distributions in the short run in 2021. 2022, we talked about the restoring balances effect over the long run is number 6 there after 2022. State aid to schools, that's a possibility that we may get a decline in enrollment if parents are afraid to send their kids back to school in the fall. And since state aid comes on a per pupil basis, that could mean a decline in the short run for state aid. Median run, if states revert, if the state has reversions below appropriations, that could reduce aid in fiscal year 2021. State aid to schools of the long run, the budget is going to be based on the forecast this December. The forecast this December will be pessimistic. The economic forecast. So the budget in 2022 and 23 likely to show very small increases in appropriations. And then finally, the last one here, this is the one that is affecting local governments right now, and that's state road funding. That's collected from motor fuel taxes each month and distributed in the motor vehicle highway and local road to street accounts. In the May distribution was down 12% from the year before, and we're likely to see that shortfall continue. So that means road construction funding is down already right now. Tamara, that's what I have to say. Let me turn it back to you, and we'll set up these breakout rooms.
So I see in the chat a question from one of the breakout sessions for the other breakout sessions. What are people doing to educate the public about these potential budget issues? Have you started that conversation with your department heads or the greater public at large yet?
In Floyd County, we haven't done anything at the greater community level, but the department heads did receive letters. We were anticipating maybe doing some furloughs, and so a letter went out to all the department heads, so they know that we do. And in that letter, it stated that we know that there's going to be budget shortfalls and that we're going to have to take some serious looks at things. So they are all very well aware that we are looking already, and that that it's serious, that we have to get our budget balanced. So, but we haven't done anything for the greater community at all. And I'd love to hear if anybody else has, or how to go about that, because I think it's important.
You know, kind of related to that topic, in our session, the question came up, and it was kind of directed towards Larry, so we're sure you have the magical answer. But as units know that there are going to be rescissions or cutbacks coming through, is there some sort of recommended formula that they should be looking at to begin monitoring, reducing, doing something to their current spending so that they can kind of start to stockpile for future?
Well, there is no magic formula. if you did build up a rainy day fund, it's raining now, and this would be a perfect time to draw upon it. You know, we've used rainy day funds mostly for budget flexibility, but now's the time. So there's that. It was pointed out in the group I listened to, and we know this, that by far the largest share of local government budgets is personnel. And so I fully expect that any scheduled raises would be postponed. Certainly that's already happened at Purdue, the government organization I work for. So I think we expect that to happen. You know, you've got a year and a half essentially before the big hit in 2022. It's time you could rearrange how your local income tax money is distributed, or even increase that rate. That can be one thing that can be done. But you're right. Okay, there's no magic formula here. The state and local governments have to balance their budgets. And if there's less revenue, there's less expenditure, and every, you know, and point it out this way: there's no local government in this state doing something that they don't think is necessary, and that means you're going to have to cut something that we think is necessary, and that's just the way of the world.
Well, and I mean, the nice thing is we do have some lead time as local governments, unlike maybe some households right now that are facing unemployment. And so you can do, you know, if you get into the late third quarter of this year or the fourth quarter and want to do a revision because you haven't spent, you know, maybe your mileage fund or things like that, then you can do that and put that into rainy day for next year or 2022 when we're hitting, things are a little tighter. I know Denise also kind of asked, is there anybody doing any sort of education with the public? I wanted to bring that back up just one time in case somebody wanted to answer and hadn't. Sounds like that's a resounding no. And so maybe that's something to think about. You know, if there's something that Larry and I can do to distill from this to help with that, I think we're happy to do a video or something that's more public facing. I also want to open it up for questions for Larry. If we think back to the presentation, and Larry, you're welcome to share your PowerPoint too. So if you've got any questions, feel free to raise your hand and I can call on you, or put a thumbs up and I'll call on you, or you're welcome to write it into the chat box. George, you look like
I have a question that came from one of our breakout room, and this is for Larry. So the participant was wondering if the legislature will reconsider property tax caps in terms of how it's going to help, you know, local government funding.
Well, and I think that they just said property tax controls, so perhaps the maximum levy growth quotient.
Yeah, when we say property tax caps, those are in the Constitution, and so on purpose, right? They're not going to go away. They're as I always like to say back in the day, the only reason they're not carved in stone is that we don't do that anymore, but they're pretty permanent. What about other property tax controls? Well, you know, we did revise the maximum levy growth quotient back after the recession of 2001, but as it turned out, we tightened it. We didn't loosen it up. So I don't know. You know, I didn't mention this, but the Congressional Budget Office projection on personal income for 2020, I said, was -2, but for 2021 it was 0.3, which would be another hit on the thing. The idea behind the maximum levy growth quotient is to keep the levy from growing more than the incomes of Indiana residents, so that it stays within the range of their ability to pay over a period of 6 years. what the formula is telling us is that, hey, people who have lost their jobs still owe their property taxes this year, and we're going to make it up to them over the next 6 years. Now, whether we reconsider that, I don't know. I guess I wouldn't expect to see a revision in the property tax controls in the property tax maximum levy. But like I said, who knows? This is going to be an extraordinary budget session coming up next year, and many things may be on the table that we don't expect. But just to say, the maximum levy growth quotient formula has only changed once in the last 20 years, and only 2 or 3 times marginally since it was established in 1973. So those are few and far between, and crises don't seem to affect them.
So Patty Stringfellow just offered that as the library director, she's had discussions with the board and staff, but not with the public yet. And a lot of the discussions right now have to do with slowing and reducing spending to retain as much of an operating balance as we can at the end of the year.
I think, in a sense, the communication with the public is going to come naturally in the second half of this year as the budget deliberations go forward. And, obviously, knowing what's coming in 2022, local governments will make adjustments in 2021, and the local papers and so forth, local media will pick up on that. And that's probably an opportunity as part of the news cycle to warn people what's coming.
Danny asked, when would the state of Indiana know if the federal government is going to issue funding to cover some or all of the potential deficit?
Well, they'll know when we do. It's the House has put something on the table, and the Senate at the moment is saying no. That's what I'm thinking, is that if the Senate hears from their governors and other local governments, state and local governments, maybe they can be pushed in that direction. But when it passes the Senate, and if and when it passes the Senate, and if and when the president signs it, then we'll know, and then they'll know. And in very short order, they will be looking very closely at what the formulas are for the distribution of that money if it passes, and that's when they'll know.
I think Ron from Delaware has a question. You want to unmute yourself, Ron?
I don't know how.
Let's
see.
We can hear you. You can just talk.
You can hear me? Okay. Communications is one of my key words in life. I really believe that's where we fail a lot. And as local officials, even though we're all having the same problems or things to face, local newspapers are not local anymore. Even our big monthly paper is owned by USA Today, and very difficult to communicate with them. They choose what they want us to see. I wonder, and Larry is pretty highly respected throughout the state. So is Purdue. Molly is in our community. Some way, somehow, we need to communicate with the public locally in a better way than the newspaper, my opinion.
Cameron, we'll have to figure that out. Summer project. Here's what's coming, citizens, taxpayers, recipients of local government services. So a couple of lean years coming up.
Well, and we've always wanted to do a program for media on how to report on local government finance. Maybe it's time to relook at that.
Yeah, what we'd have to learn what media is left, in a sense. I know we've got a local government reporter in Tippecanoe, and my wife subscribes to the Commercial Review from Jay County, Portland, which does a marvelous job at covering local government, but they're locally owned. But I know Ron is right. These are nationally owned newspapers that occasionally put resources into local coverage and occasionally do not.
Larry and Tamara, I actually have a meeting at 12:30 today with the University of Arkansas Extension on a very similar topic that aligns with that. So I will report back out to you afterwards.
That's actually our partner in crime that we've been trying to get it off with, or get it out with. University of Arkansas does quite a bit around training media, which is kind of cool. I wanted to, Susan Preble put a statement in the chat box, and then I'll wrap things up. Larry and I can stay for a few minutes to answer questions still. She says the governor can share more of the coronavirus relief fund Indiana received with locals if his administration wants to. That's over $300 million. He's already committed. So just to point that out. I want to thank you all for attending today and sticking with us. We really appreciate you being willing to test out the technology and try something new and make this a little bit more participatory of a webinar. We really also value your expertise on the ground. And so we'll compile those notes from the last 2 days and send those out along with the recording so you can see what happened in the other breakout sessions to a certain extent as well. I also want to give a huge shout out to our county educators that are on. If you guys can turn on your cameras and give a wave or something. They put in a lot of extra time to be able to not just be a host, but really understand some of the material and be able to facilitate. So we greatly appreciate them taking that time to support their local communities, but also local government across Indiana. So thank you so much all for joining, and you'll receive the recording by the end of the week.
Thanks a lot, everybody.